Today, Goldilocks and the PushMi-PullYu economy. Hello again, it's Martin North from Digital Finance Analytics Web, and that is post covering finance and property news, and this is our weekly market update. Well, the question is Goldilocks real after all? Because just 25 days into 2024, the S&P 500 has now surpassed the median price target that Wall Street banks had set for the end of this year. So it's another weird week on the markets. Things do, though, remain confusing. And next week, the US stock market's strong start for the year will face a major test in a stretch packed with big tech earnings, with 40% of the companies on the S&P 500 delivering their results, including Microsoft on January the 30th, and Alphabet, Apple, Amazon, and Meta platforms on February the 1st. And of course, the Federal Reserve's monetary policy meeting will be on January the 31st, as investors have pushed expectations for the Fed's first cut of the cycle from March to May. Markets are now pricing in 135 basis points of cuts by the end of the year. That's down from over 160 basis points expected in December. And of course, we'll also get a closely watched employment report. Plus, early next week, we're also going to have the next quarterly refunding announcement, the QRA from the Treasury, which will set out its plans for debt issuance over the next 3 months. The question here will be how much debt the US government needs to issue and the strength of demand for that debt, which has become increasingly important in the last year, and these QRAs have taken on extra significance. And interest rate payments, by the way, on that debt hit $1 trillion as a percentage of federal income and federal spending. It is closing in on all-time highs. But bond yields are holding on at lower levels, with the 2-year at 4.357 and the 10-year at 4.139, and the DXY was 103.47, and the VIX was at a low 13.26, so all over the shop. That said, on Thursday night, the S&P 500 hit its 5th all-time high in a row, as US GDP growth numbers showed that the US is powering along, with the 3.3% growth rate much higher than the 2% that economists had expected. Prominent US commentator Ed Yardeni asks if we're starting to see a tech-led melt-up on markets where we shift from immaculate disinflation to irrational exuberance. And on Friday, the PCE, which is the Federal Reserve's preferred gauge of underlying inflation, cooled to an almost 3-year low, even with robust holiday spending keeping the debate live about whether officials will soon cut borrowing costs. The core personal consumption expenditures price index, which excludes volatile items like food and fuel, slowed to a 2.9% pace in December from 3.2% a month earlier, which was below economists' estimates of 3%. That's according to the Bureau of Economic Analysis. From a month ago, it advanced 0.2%. Consumer spending, which makes up the bulk of economic growth, surprised to the upside, rising 0.7%, well above estimates for a 0.4% rise. And underpinning ongoing optimism, the Fed's measures to cut inflation are unlikely to push the economy into severe recession. Inflation-adjusted consumer spending climbed 0.5% in December for a second month. That's the biggest back-to-back increase in nearly a year. And that was fueled by another strong advance in wages and salaries. So Friday's report caps a year that saw inflation retreating at a much faster rate than the Fed and Wall Street economists anticipated, all while a steady jobs market kept powering consumer spending. While some of that momentum is expected to moderate this year, many forecasters still see the economy dodging a recession. Previously, that might have brought concerns that the Federal Reserve would keep interest rates higher because of the resiliency of the economy. But the report does suggest that inflation was continuing to cool. But that said, federal officials have been cautious to declare victory on inflation and have said they want to see sustainable signs of cooling before lowering borrowing costs. And while they've started to discuss such a move, policymakers are expected to keep interest rates at a 2-decade high when they meet next week. And Wall Street's new high also came despite Tesla's selling off more than 12% after its December quarter numbers revealed a big drop in profits and a poor growth outlook, which the company's chief executive, Elon Musk, did little to explain on a train wreck earnings call. Indeed, US data firm Bespoke Investment Group has trimmed the Magnificent Seven, Apple, Amazon, Alphabet, Meta Platforms, Netflix, Nvidia, and Tesla, to the Magnificent Six, given the latter's shares are now down by almost 27% year to date. Collectively, the market capitalization of Alphabet, Microsoft, Apple, Amazon, and Meta account for nearly 25% of the S&P 500, giving them an outsized influence on the performance of the broader index. But even that's a little misleading, because really, the S&P's gains this year have been driven by three of those tech giants: Facebook, owner Meta Platforms, which is up 13% this year, AI chipmaker Nvidia up 28% this year, and Microsoft up 9% this year. Indeed, Microsoft celebrated a nice little milestone on Thursday night, closing for the first time with a market capitalization above $3 trillion US, and is closing with a market value bigger than Apple for the first time for a long time. So while the market is being driven by a handful of pretty expensive stocks, December quarter earnings looks fairly middling, even against consensus expectations, which were lowered significantly coming into this earnings season. But there's no shortage of complacency in this market. Volatility remains extremely low, and short selling has decreased. The old adage of past melt-ups, if you're not long, you're short, seems to prevail. Overall, next week is the largest risk event week ahead in recent memory, wrote Numera strategist Charlie McGilliot. On Friday, the S&P 500 ended its 5-day record run, though still ended the week in positive territory, while the Dow Jones Industrial Average was up 0.16%. The S&P 500 fell 0.07%, while the Nasdaq Composite fell 0.36%. And tech giant Intel disappointed first quarter guidance and sent its shares down 12%, and pressurized tech stocks more broadly. While Intel's guidance misses with a negative, there was some reason for optimism according to Deutsche Bank, as weakness wasn't in Intel's core PC and data center businesses, and management touted a return to growth this year. Intel expressed significant confidence in quarter-on-quarter and year-on-year revenue and EPS growth returning to the remainder of 2024, Deutsche Bank added. As well as Intel's dump, chip stocks were also dealt a blow by a more than 3% decline in Western Digital Corporation, despite the many chip makers' better than expected quarterly result and guidance. The earnings season continued on Friday with T-Mobile US, which was marginally lower after the wireless carrier missed its profit target for the fourth quarter, even as it forecast monthly bill-paying phone subscriber growth for the year above estimates, and banking on a 5G coverage rollout and promotional offers drawing consumers. American Express stocks rose 7% after the credit card giant beat full-year profit expectations, but it raised its loan loss provisions, bracing for a jump in potential loan defaults. And its main rival, on the other hand, Visa, fell 1.7% after it offered up tepid second quarter sales guidance, with the world's largest payment processor forecasting an uptick in the upper mid to high single digit in net revenue during its current period, implying a slowdown from the 11% increase posted in the corresponding period in 2023. Now, in the oil sector, oil prices rose for a second week and settled at their highest in nearly 2 months on Friday, as positive US economic growth and signs of Chinese stimulus boosted demand expectations. China's, of course, the world's second largest oil consumer, announced a deep cutback in bank reserves to spur economic growth earlier in the week, while oil supply disruptions in the Red Sea continued. Brent crude futures rose 1.52% to settle at $83.78 a barrel. That's their highest close since November the 30th. And US West Texas Intermediate crude climbed 1.12% to $78.18, also the highest close since November. Both benchmarks made weekly gains of more than 6%, marking their biggest weekly increase since the week ended October the 13th, after the start of the Israel-Hamas conflict in Gaza. And of course, higher oil prices equal higher inflation later. Oil was also boosted earlier this week by a larger than expected drawdown in US crude stockpiles. The depletion in inventories, especially around the WTI delivery point at Cushing in Oklahoma and across the Midwest, could create a squeeze on nearby futures prices. Gold futures rose just a little, 0.02% to $2,018 an ounce. In fact, gold has suffered a huge disconnect from inflation in the last few years, eroding confidence in it. The Fed's monster rate hikes meant that gold plunged more than 20% into a new bear, just when it shouldn't have been the case. Though now that's been fully reversed by the middle of 2023, that extreme anomaly sure soured traders on gold. Gold tends to move counter to stock markets, making it a great portfolio diversifier. But when stocks are challenging record highs, prudent diversification is forgotten. Alternative assets, led by gold, tend to shine again as lofty stock markets decisively roll over. And when the elite S&P 500 companies averaging dangerous bubble level 30.3 times trailing 12-month price earnings ratios entering January, well, that reckoning could be looming. Over in Europe, European stock markets traded in a mixed fashion on Friday as investors digested corporate earnings and the signals from the European Central Bank's recent meeting ahead of the release of key US inflation data. The DAX index in Germany traded 0.32% higher, while the CAC 40 in France traded up 2.28% and the FTSE in London rose 1.4%. The ECB kept interest rates unchanged at a record high of 4% on Thursday and gave no hint that it would even contemplate a start to easing, with President Christine Lagarde twice noting in the accompanying news conference that it was premature to discuss rate cuts. However, she also recognized that inflation had fallen faster than the ECB had expected last autumn, suggesting that the time to start discussing a first rate cut is fast approaching. A change in tone at the ECB's meeting in March, when the central bank is also set to issue new economic projections, could clear the way for a rate cut, perhaps in June. Such talk could also help to boost consumer confidence, which is badly needed judging by the latest German sentiment figures. The GfK German Consumer Sentiment Index fell to minus 29.7 points heading into February from a revised minus 25.4 the previous month, suggesting a sustained recovery for Europe's biggest economy remains a long way off. Looking at specific stocks, LVMH stocks rose 8% as the market reacted to the world's biggest luxury group, posting a 10% rise in fourth quarter sales late on Thursday as growth edged up from the previous quarter, driven by resilient demand from its high-end fashion over the all-important end-of-year period. And of course, this just shows that some people still have plenty of money and are still spending hard. Remade Cointreau stocks soared 11% after the French spirits maker posted a slightly smaller than expected decline in third quarter sales, helped by a sequential improvement in the United States and major destocking in China ahead of the Chinese New Year. On the flip side, AB Volvo stock fell 2% after the Swedish truck maker said it would gradually cut production following years of supply chain disruptions. Now in Asia, most Asian stocks retreated on Friday as a stimulus-driven rebound in Chinese stocks stalled, while Japan's Nikkei 225 slid further away from its 34-year high on growing bets that the Bank of Japan would pivot, spurring more profit-taking. A rebound rally in Chinese stock markets appeared to have run out of steam, with the Shanghai Shenzhen CSI 300 falling slightly on Friday, while the Shanghai Composite Index rose just a little. The two had rebounded sharply from 5- and 4-year lows this week after the People's Bank of China unexpectedly cut its reserve requirement ratio for local banks, freeing up about 2 trillion yuan in liquidity. As a result, the two Chinese benchmarks still added around 2% this week. That's their best weekly performance since July last year. Hong Kong's Hang Seng Index fell 1.6%, with heavyweight Tencent Holdings among the top weights on the index, after Citibank cut the internet giant's price target, warning that a slowdown in China's video game industry was likely to weigh on revenue. Even so, the Hang Seng rebounded from a 15-month low across the week, or around 5%. But analysts questioned just how much economic support more monetary stimulus would provide to the Chinese economy, given that consumer and business spending in the country remains weak. Business activity also failed to pick up substantially over the past year. Purchasing Managers' Indices data for January is due next week and is expected to provide more cues on business activity at the beginning of the new year. Japan's Nikkei 225 index was the worst performer on the day, down 1.36%, while the broader Topics index showed 0.8% on profit-taking after surging to 34-year highs earlier in the week. Weakness in Japanese shares came following somewhat hawkish signals from the Bank of Japan, specifically Governor Koichi Ida. He said that while the bank will maintain its ultra-dovish policy in the near term, an end to the bank's ultra-low interest rates was in sight, especially as inflation moved closer to the bank's 2% annual target. In fact, softer-than-expected inflation data from Tokyo furthered this notion on Friday, with core inflation falling well below 2% for the first time in more than 20 months. While the timing of the Bank of Japan's potential pivot remains uncertain, any increase in Japanese interest rate portends an end to a nearly decade of ultra-loose monetary conditions enjoyed by local stocks. A dovish Bank of Japan was a key driver of Japan's stellar stock rally through 2023. Broader Asian markets were mixed, with South Korea's Kospi an outlier for the day, up 0.33% as it rebounded from a 2-month low hit earlier in January. And Indian and Australian markets were closed. In the past 12 months, it's worth noting that Hong Kong's benchmark Hang Seng Index tumbled 26%, the CSI 300 lost 22%, and the wider Shanghai Composite Index slumped 15% over the same period. Japan's Nikkei Index gained 24%, and the S&P 500 in the US 27% higher. Geopolitical issues have also caused some pullback in capital from China, although the current risk premium does make Chinese assets more attractive. It's also worth noting that the Chinese property sector remains a risk, as a key offshore bondholder group of China Evergrande plans to join a petition to liquidate the developer at a hearing in Hong Kong on Monday, according to Reuters at least. The bondholder group owns more than $2 billion in offshore notes guaranteed by Evergrande, and its support to a winding up petition against the world's most indebted developer increases the chance of an immediate liquidation order from the court, according to lawyers. If a liquidation order is issued, a provisional liquidator and then an official liquidator would be appointed to take control and prepare to sell the developer's assets to repay its debts. The liquidators could propose a new debt restructuring plan to offshore creditors holding around $23 billion of debt in Evergrande if they determine the company has enough assets, or if a white knight investor appeared. And they'd also investigate the company's affairs and could refer any suspicious misconduct by directors to Hong Kong prosecutors. Evergrande could appeal a liquidation order, but the liquidation process would proceed pending appeal. And even if the liquidator were to take possession of units that have onshore projects, many of these have been taken over by creditors, frozen by courts, have little value left, or are even in negative equity because of falling property prices. So while a winding up of the developer with $240 billion of assets would send shockwaves through already fragile capital markets, experts said that it would not offer a blueprint on how liquidation might unfold for other embattled developers. And given the sheer size of Evergrande's projects and debt, the process would involve many authorities and political considerations. Now, in Australia, the Australian share market went into the Australia Day long weekend on an upbeat note on Thursday, ending its 5th straight session higher. On Thursday, the ASX 200 closed 0.5% up at 7,555. The All Ords was up by a similar margin. So the ASX was up 1.8% since last Friday, with technology stocks the only sector in the red over the 4-day stretch. Iron ore miners led Thursday's gains, with BHP, Rio Tinto, and Fortescue all rallying up by more than 1.5%. Tracking, of course, the iron ore price higher, because iron ore futures in Singapore pushed above $136 per tonne for the March contract after the governor of China's central bank flagged that reduction in the reserve requirement ratio for banks within 2 weeks. Meanwhile, Fortescue maintained its financial year 24 production guidance in its lately quarter report after shipping near record levels of iron ore in the first half of the financial year. Elsewhere, local tech stocks slipped 0.7% after US automaker Tesla reported weaker than expected results and warned of a sharp slowdown in volume growth this year. On the ASX, Afterpay-owned Block fell 5.5% to $95.27, and WiseTech Global dropped 2.3% to $73.21. And finally, in crypto, Bitcoin is trading down as much as 20% since the launch of those ETFs. It was last at 41,692. Before the launch of the ETFs, the markets were expecting massive inflows. And while we are seeing those inflows, there are also outflows, particularly from the Grayscale Bitcoin Trust, and they've outpowered the inflows on several trading days. Originally launched back in 2013, the Grayscale Bitcoin Trust, or GBTC, allowed investors to access Bitcoins through a traditional investment vehicle originally available only in OTC markets. After many regulatory battles, the SEC finally approved Grayscale's application to turn the trust into an ETF in January 24, and GBTC launched with fees multiple times higher than the competition. So the question is, why would you stay in GBTC if the same product offered by BlackRock or Bitwise is 20% of the costs? And so currently GBTC is losing roughly $500 million per trading day, totaling a loss of about 16% of the fund's value since its launch. And since the launch of the ETFs combined, they've acquired an impressive 123 Bitcoins in just 9 trading days, and currently around 6.25 Bitcoins are being distributed into the network every 10 minutes, which equates to a Bitcoin supply of around 900 Bitcoins per day. Though keep in mind that after the halving event in April this year, the rate of supply will be cut in half to 450 Bitcoins per day. So if you stand back and think about all this, you can see that there's a lot of complexity, a lot of signals pulling in different directions, and I still think that the Goldilocks quest is far from certain. Particularly because, as I've noted, the markets in the US are not actually performing that well across the board. They're being supported by a very small number of stocks with very high multiples. And so the next couple of weeks will be quite critical. If we start seeing results coming in a bit below trend, possibly those valuations could reverse. And if that reversal does start to take up momentum, then the markets could be significantly down. But then, of course, the Federal Reserve has also the opportunity, if it wants to cut rates, but I don't think they'll cut until later in the year, and it might well be the ECB that ends up cutting first. And as for the crypto markets, well, they're still quite unpredictable, and the flows in and flows out will probably hold the Bitcoin price relatively stable in the medium term, but with some upside perhaps down the track. We'll see. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.